makers and market movers. This is The Pulse with Francine Lacqua.
Morning, folks. Fran's out today, so I'm in. Let's talk you through what we're going to be getting. We need to talk about some of the data we are watching. We are looking at the IFO Institute's numbers coming out. We're going to be speaking to Clement Fuest very shortly, and the numbers actually look a little bit better than anticipated. 86.9 is the headline business climate index. The survey there was 85, so that number looks a little bit better than anticipated. The current assessment definitely looks better than expected at 86.4. Expectations, though, is where my eye is really drawn to. So no real dip there. So what you've got in Germany at the moment, which is kind of really interesting, is you've got the tariff hit, which you need to be paying attention to. But you've also got the fiscal story coming through from Germany. And it's this kind of duration mismatch between those two factors that are really interesting at the moment. So we'll get into that conversation in just a moment and figure out exactly what is happening. Clement Fuest is the president of the IFO Institute, and he'll be joining us very, very shortly. Another factor I just want to mention as well is that IBM is slumping pre-market. Keep an eye on what is happening with big tech. You've got a whole load of names out today. But Big Blue is having a big day in the red this morning, down by 7, nearly 8%. First thing as we head towards the start of the US trading session. So we'll look forward to what is going to come out of big tech a little bit later on. In terms of where we sit with these markets right now, you had a decent rally over the last couple of days. Like it says on the screen in front of me, it was a brief rally. 2 days of 2% gains is not to be sniffed at. And it appears to have come as we've seen maybe some evidence that the market is taming Trump. And you've seen this coming through in terms of what he's been saying, what the administration has been saying when it comes to what is going on with the China tariff story. Pulling back. You've also obviously had the Fed story to fold into that narrative as well. The US president raising the possibility of, quote, a special deal with Beijing in the next 2 to 3 weeks.
We're dealing with a lot of countries right now, and could be with China, but maybe we'll make a special, a deal, and we'll see what it will be. Right now, it's 145%. That's very high. It got there because of the fentanyl. They're sending, massive amounts of fentanyl into our country.
President speaking yesterday. Let's bring in Bloomberg's EMEA News Director, Ros Matheson. What do we actually know? Because the conflicting signals continue. Trump sounding more positive, Bessent sounding quite cautious.
Well, that's right. And there's a lot we don't know in all this. What we do know is the rhetoric, at least, is starting to tone down. Yep. That's clear from across the board in the US administration. But we don't know tangibly what that's going to lead to and when. There's a lot of conflicting comments and reports about would they lower tariffs on China before negotiations? Are they already negotiating with China? According to the US, they're in talks every day. But we've just had a barrage of comments out from various ministries in China, all back to back. Commerce Ministry, Foreign Ministry, also comments today from the PBOC. And the narrative there is that, hang on, we're not in talks with the US at the moment on trade at all. We don't know what you're talking about when you're saying that we're in negotiations, because we're not. And we want the US to lift what they call these unilateral tariffs before potentially a conversation happens. And so are we in the realm of the US having to do something in order to get talks? Do we have talks at which something may happen? When would those talks happen? At what level? There's just a ton that we don't know. I mean, the real thing is, in the end, you need to get Xi Jinping and Donald Trump on the telephone, because that's where deals really get done quickly. Yeah. If Donald Trump's talking about 2 to 3 weeks, what he really needs to do is talk one-on-one with Xi Jinping and get an arrangement, because trade deals don't happen in a nanosecond. It's very easy to put tariffs on in a minute, but getting a trade deal and a comprehensive understanding, that takes ages.
And who calls who, I think, is the big question, because at the moment the administration in Washington seems to be suggesting that Beijing is the one that needs to pick up the phone first and make that call. Beijing doesn't feel, it appears, minded to that. Ros, great stuff. Thank you very much indeed for updating us. Bloomberg's EMEA News Director, Ros Matheson. It's also worth noting that it's 100 days next week, I think it's Wednesday, of the Trump administration. Do we need to see deals getting done, or at least a deal getting done, before that, even just a term sheet in terms of what that deal could look like? So I think that is going to be something you want to watch out for over the next few days. But certainly we have seen significant volatility and significant uncertainty. And are we starting to come through to the end of that? Is the market looking forward to a lower volatile environment, a less volatile environment going forward? It was really interesting. Citadel's Ken Griffin was talking about this yesterday. And while he is on the same page with Trump on many things, like Harvard University, he is not on the same page when it comes to this tariff war.
The trade war, which has devolved into a nonsensical place, means that we're spending time now thinking about supply chains, thinking about strategically how we're going to source goods around the world. And I'll tell you what's not going to happen is people are not going to race to build manufacturing in America. Because with the policy volatility, you actually undermine the very goal you're trying to achieve.
Ken Griffin. Okay, let's talk to Miles Bradshaw, Head of Global Aggregate Strategies at JP Morgan Asset Management. Good morning.
Morning, Guy.
Nice to see you.
Yeah.
Are we past peak uncertainty? Do you feel that the markets are beginning to tame Trump?
I would not use that word, firstly.
Yeah.
I think, you were discussing earlier, I think we all know that we're going to have a continued period of policy uncertainty. This is a very different administration, but it's quite clear at the same time that the rhetoric is not increasing.
Yep.
It may be 2 steps back, 1 step forward, I don't know. But it looks to me that we are looking at less bad news coming, less uncertainty coming in the near term. And I think what matters is really what markets are pricing and where the opportunities are right here, right now. I have more conviction to say this market is pricing a lot of risk premium that's attractive, whereas this market is not pricing attractive risk premium. More conviction on that than I do on exactly what the steps are the White House is going to take in the next few weeks.
So if uncertainty comes down a little bit, you therefore could look at those markets and say, we should take more risk there, we should take less risk there. So are you poised, therefore, to make that move, to make those recommendations?
Absolutely. I think there's been a few features of the market. The first is the classic technical factors that drive markets beyond fair value in any risk-off period where liquidity collapses, volumes explode, and you get a whole degrossing phase going through markets. That's created opportunities in fixed income. Whether you look at the shape of the Japanese bond curve, when you look at the underperformance of gilts or swap spreads in Europe, all these micro trades have created opportunities. The big question is obviously what happens next with policy, and we can come back to that. But even if you dial back tariffs, you've got to answer the question, what's going to happen with fundamentals? Yeah. And that's what's going to be driving markets.
Okay, so let's talk about that. Where are we go through a period of uncertainty. Tectonic plates are shifting, things are changing. We don't know how long that period is going to last, but maybe we're starting to get to sort of the beginning of the end of that phase. Mm-hmm. What I don't know yet is what kind of the paradigm we're going into. What is that kind of? What is the new investment space going to look like? Is it the same as the investment space that was before, i.e., American exceptionalism, big gaps between US assets and the rest of the world, or is it something different?
We think, our head of FX, Nick Wall, has had a great call on the dollar, and I think there's a lot to be said that US exceptionalism is probably going to be fading.
Right.
Now, that means that the dollar may be under subdued pressure and weakening over the course of the next few years. But I think it's going to be a macro evolution where it's not a question about capital fleeing the US. It's more about valuations in the US normalizing to the rest of the world.
Yep.
And I think the fundamental driver is really going to be about growth and inflation. That's really what is going to determine what happens next. And obviously, understanding the impact of tariffs and having a view about whether we need to be more worried about inflation or more worried about growth is going to be the key for positioning in the bond market.
So what do we... OK, let's talk about the bond market in a bit more detail. Europe, it seems, and certainly the language coming out of ECB speakers over the last 24 hours has... We don't have an inflation problem, we might have a growth problem. Mm-hmm. Therefore, we're going to cut rates.
Yes.
What do I do with that?
What do you do in Europe?
Yeah.
I look at what's priced in the market, and I think there is some upside there, but it's not nearly as significant as it is in the US. So Europe, already the market has reflected a lot of these issues, and we've now pricing ECB rates in the order of 1.5% and neutrals at 2%, and so you could have, in a weak growth scenario, you could have them below 2%, but US rates are priced to be above 3%, above their neutral rate over the next few years, and that's, I think, where there's tremendous opportunity.
So at the moment it appears that Europe is relatively understandable. Rates are going to come down, the bond market here, and whether or not the bonds are a safe haven and more of a safe haven than treasuries, I think we'll come back to that in a moment. In the States, we just don't know, because there's two factors at play here, one of which we don't understand what the inflationary outlook is going to be, and the Fed's reaction function to that. At the moment, the labour market is holding up. But what we also don't understand is whether or not this US flow story out of the US means that ultimately the long end stays, even if the Fed was to cut rates, long end rates stay high and you end up with a very steep curve.
Yeah.
How likely a scenario could that be?
Well, I think, any recession tends to lead to a steeper curve. Short-term rates fall significantly. The market expects rates to go higher. And the curve, 2s, 10s in a recession could be at 200 basis points. So I think that is one conclusion that seems quite compelling, is the yield curves are likely to steepen. Importantly, is tariffs more of an inflation shock or a growth shock? And my view is it's more of a growth concern. And the Fed being on hold for longer makes me more convinced that actually ultimately they will have to cut rates more.
But is there a flow story here as well, which is so when Greenspan hiked rates aggressively, 10-year didn't move. And the reason the 10-year didn't move was there was loads of money coming into the US market, which effectively held down US rates. Are we going to see the reverse of that, i.e. money leaving the States, leaving the US Treasury market? So the Fed cuts, actually what you end up with is fewer buyers in the 10-year, and actually rates stay relatively high.
I think rates will come down, but not as much as we've been used to over the last 14 years.
Right.
The last 14 years, rates were at zero, you had forward guidance, quantitative easing, and that lowered long-term forward rates. We had deflation fears. We're not going to be in a world of deflation fears and forward guidance, but I would expect 10-year Treasury yields to fall in a classic monetary easing cycle rather than to go up.
Because of deficit concerns, and we didn't see any evidence of that in the auction yesterday. Foreign buyers owning less.
We haven't seen the evidence in the data of foreign buyers earning less. What we have seen, I think, is risk premium coming into the market, and as much of that, I think, is about the technical factors. Over the last 15 years, you've had increasingly hedge funds becoming a more important part of market making in Treasury bonds because of regulations and stuff like that. So I think that's been a key feature driving markets. But clearly, you need to have some policy stability in order to have conviction that the macro fundamentals will be the key driver of markets. So the staging posts have to be, we need to see more of what we're seeing, which is less confrontational tariff rhetoric, less rhetoric about removing Jerome Powell. And then the question for the market, and I think this is where the opportunity is, the market is not pricing that macro scenario yet.
We will watch and see if it does. Nice to see you.
Thank you.
Thanks for stopping by. Miles Bradshaw, Head of Global Aggregate Strategies at JP Morgan Asset Management. Mentioning there what we are seeing on the tariff front. So let's turn our attention in more detail to what is happening there. The Trump administration is considering whether to reduce certain tariffs targeting the auto sector. It comes as industry executives warn that levies could deal a severe blow to profits and jobs. Joining us for an update on this is our Global Head of Autos, Craig Trudell. Bring me up to speed.
So I think the first thing we should lead with is Trump has not signed off on any of the things that we're about to talk about here. So a lot of moving parts, and apologies for the pun there, because we are going to talk about auto parts here as well. There's a lot that the industry, does not like about the tariffs that are sort of hanging over their head. One of them being this idea that they face potential for stacking, where there's a lot of steel and aluminum that goes into their parts. Are they going to be subject to higher tariffs, both for that raw material and the end part? There is some sort of speculation or talk that we're picking up on from the White House that maybe they will de-stack and not hit those components twice. But in terms of particulars and nailing down what exactly is going to change here, nothing has been signed off on, nothing finalized at this point.
But this is the nuance that is important, though, isn't it?
It really is. And I don't think that we have a real sense that the administration necessarily is thinking about the nuance and sort of grasping the nuance with the level of urgency that the industry is looking at this with, because May 3rd is when parts tariffs kick in. So this is just around the corner for this industry.
Let's talk about the sales story out of Europe. Germany, France not looking good this morning, but actually the UK data stacking up a little bit. Tesla hasn't had a good time, but actually EV sales in the UK look relatively okay.
Yeah, and of course March is always a big month here in the UK for plate registration month. But this it is really interesting that the numbers when you look at Europe wide, small declines January and February, a 2.8% rise in March, as you say. Largely the UK sort of driving growth there. Under the surface, though, this was a really dramatic first quarter where you had battery electric vehicle sales plus 28%, hybrids plus 20%, petrol minus 21, and diesel minus 26. So in this, first quarter where we see, in the end, 0.4% change in sales, huge changes beneath the surface of those ho-hum headline figures.
Can I ask you a slightly bigger question? When the EU and the US sit down and ultimately talk about tariffs, cars are going to be on the list. And there is this idea that maybe reducing tariffs on US vehicles into Europe would have a big effect. How much demand is there from Europeans for US vehicles?
I've enjoyed, just as an American living here in the UK, reading some real sort of blistering stories from, cars columnists who say, sorry, Americans, we just don't want your vehicles. It doesn't matter what the tariff treatment is for these. They're bigger than what you see on the roads here. We don't buy F-150s and Silverados over here in Europe, or to the extent that we do, it's in quite small quantities.
There's an F-150. The guy down the road's got an F-150 near to it. It is huge. It looks massive on the roads.
Sticks out like a sore thumb. Yep. And so, you also have a situation where GM basically isn't here in Europe anymore. And so you don't have, American companies themselves who have a desire to sell more here. They've tried it. They've decided, it's not even worth it. We're going to pull out. And GM made that decision, quite some years back. So will there be a meaningful sort of opportunity for American companies to sell more here? I'm quite skeptical, especially since you have local plants for some of those companies that do sell here, like Ford and Stellantis, that, in the end, there's overcapacity still in this industry locally.
Our parking spaces are quite small.
Quite tight, yes.
Trying to get one of those big trucks into them could be slightly problematic. Craig, nice to see you. Thanks very much indeed for updating us. Our head of Autos, Craig Trudell. Coming up, we have heard from the president of the Bundesbank warning on the possibility of a German recession. We're going to discuss the outlook for Europe's biggest economy. Clemens Fuest is going to be joining us in the IFO Institute very shortly. Its data just dropped onto our screens. We will digest it next. This is Bloomberg. Get back to the macro data out of Germany. The IFO has just dropped onto our Bloomberg screens. Digesting it obviously is something that's worth paying attention, is worth doing, because this is data that's worth paying attention to. We've got a little bit of a pickup. Economists actually were expecting a little bit of a drop. Clemens Fuest is the president of the IFO Institute and joins us now for some instant analysis. Good morning. What should I read into the data?
Yes, it's maybe a surprise that the index has increased slightly. And what's behind that is a negative reading coming from manufacturing. As one would expect, manufacturing companies are concerned about their export prospects. They are concerned about the trade war, about the uncertainty caused by the US trade policy caused by Donald Trump. At the same time, we have positive readings from domestically oriented sectors, in particular construction. Companies are hoping that the infrastructure package announced by the new government will increase demand and will stabilize construction activity. Some positive readings also from the service sector, and therefore overall even a slight increase despite all the turbulence.
Does one offset the other?
Basically, yes, the good readings offset the bad readings. So the overall index has increased slightly, not by very much, but that's certainly more than was expected.
The president of the Bundesbank was speaking to Bloomberg yesterday and talking about the risk of a recession in Germany as a result of tariffs. Does your data tell a similar story? Is that the narrative you're hearing from German business?
Yes, I think our data maybe is a little bit more positive. At the same time, we have to see that the baseline for the German economy is that it's stagnating. So a small negative impact would push it into recession. So we are very close to the zero line. So, for instance, an escalation of the trade war could push Germany into recession. That's true.
Do we have something of a duration mismatch when it comes to the German economy? you obviously have the near-term risk of tariffs and the longer-term opportunity that comes from the higher fiscal spend. Are we in danger of conflating that timeline, i.e. we're seeing them both as being at the same time, and actually in some ways we shouldn't? The near-term risk is tariffs, the longer-term, and it is a longer-term opportunity, lies in fiscal.
Yes, maybe what's stabilizing in the short term as well is the decline in interest rate we've seen. It seems that capital markets perceive Germany maybe as a safe haven in this situation to some extent, as the US is considered more risky, and that does stabilize the economy even in the short term. But of course, the trade war is a huge short-term risk, and it's not entirely clear that these more medium-term fiscal programs, fiscal expansion programs, can compensate for that. They may come too late. At the same time, investors who think about doing construction projects may bring them forward, maybe because they think, okay, in 2 years there will be a lot of demand, rising prices in construction, so there could be a stimulating effect in the form of anticipation effects.
That's interesting. Worrying about maybe the shortages of materials being kind of a factor. How do German companies feel about a stronger euro?
That, I suppose, adds to the concerns about competitiveness, the concerns about exports. In the survey, manufacturing companies are telling us that their export prospects are negative, and the increase in the euro adds to that. What was expected was certainly the opposite, so a decline of the euro versus the US dollar, and that hasn't come out because it seems that the capital markets seem to be driving this increase in the euro.
Clemens, just very briefly, how big an impact would a lower cost of capital have on the German economy if rates do continue to fall?
It will certainly have an impact on construction and on residential construction. Residential construction has been very low in Germany, and that could be an important factor stabilizing that. So overall, a positive effect, maybe less of an effect on manufacturing investment, because there it's the uncertainty that's holding back investment, not so much the interest rates.
Clemens, great to catch up. Thanks for the instant analysis on the data that you've delivered this morning. Clemens Fuest, the president of the IFO Institute. Coming up, we're going to return back to the corporate story this morning. We've had a whole range of corporates reporting out of Europe. The banking sector front and centre. BNP's share price down a little bit, profits dipping despite a big surge in equities trading. Lars Machenil is the CFO of BNP Paribas. He joined the opening trade a little bit earlier on. We had an interesting conversation with him. We'll delve into the details of what we learned from BNP Paribas and what we can read into the rest of the banking sector. That is coming up next. This is Bloomberg. Half past, welcome back. You're watching The Pulse. I'm Guy Johnson in London. Let's talk you through the top stories this Thursday. That brief global market rally, actually it was quite a decent market rally, losing a little bit of momentum this morning. The Trump administration very much sending now mixed signals on its plans for tariffs. Shares in Kering, the luxury stock, slumping after a 25% fall in sales at its key brand Gucci. It's reviving demand. Do we have to wait? And BNP Paribas, we've just been discussing it, also lower first quarter profits falling despite a 42% surge in equities trading, as this volatility certainly delivers some exceptional returns over at that bank. Let's turn to what is happening with the geopolitical story as well, because we need to focus on what is happening there too. Russia has hit Ukraine with a barrage of missiles and drones overnight, killing at least 9 people. That's as President Trump ramps up pressure on Kyiv to accept a peace deal that critics fear will actually favour Moscow, while accusing at the same time President Zelenskiy of Ukraine of prolonging the war.
I think we have a deal with Russia. We have to get a deal with Zelenskiy, and I hope that Zelenskiy, I thought it might be easier to deal with Zelenskiy. So far it's been harder, but that's okay. It's all right. But I think we have a deal with both. I hope they do it.
Let's get some analysis here. Bloomberg's Russia editor, Greg Sullivan, joins us now. Crimea seems to be the sticking point. The Ukrainians are loath at this point to accept recognition of current borders. Is a deal possible without that?
Well, there seems to be a few sticking points here. As you mentioned, the recognition of Crimea by the U.S. was part of a broader set of proposals that the U.S. has put forward that critics say really favor Moscow at the expense of Ukraine. These are really tough points, really tough proposals for Ukraine to accept. They include putting its bid to join NATO off the table, and of course the Crimea recognition. They've been trying since 2014, when it was originally annexed, to get their land back. These are not proposals that he's ready to swallow. There's also the problem that Ukraine has said they're willing to do an unconditional ceasefire, and they want a ceasefire before any negotiations towards a final peace begins. Russia has basically ruled that out. They said they would like to see movement towards a finalized deal before any sort of ceasefire. And as we saw today with the missile barrage, that is continuing. They are continuing to fire on Ukraine. So it's really a tough position for Ukraine at this point. Where do the Europeans sit in this? Well, the Europeans are definitely very worried that the proposals put forward will sacrifice both Ukraine and their own security concerns in the rush to get a deal. They've largely been trying to slow President Trump as he pushes for a deal at any cost. They also are concerned about things like security guarantees for Ukraine. Should any deal be reached, how will that be enforced? As well as the timing of whether there will be a ceasefire before broader negotiations begin or not. So they definitely are concerned and trying to push back on some of these proposals from the U.S. Greg, thanks for the update. Appreciate it. Bloomberg's Greg Sullivan. Let's talk about what is happening with the Ukrainian leader today. President Zelenskiy cutting short his first official state visit to South Africa after we've seen the deadly Russian strikes that we've just been hearing about. Let's get more on what we learned from this trip, though, from Bloomberg's chief Africa correspondent, Jennifer Sabuzaja, who joins us now from Johannesburg. Jen, walk us through how this trip went and what we actually learned from it and what Zelensky said.
Right, Guy. You mentioned those strikes that we heard earlier today. Our understanding is that Zelensky's trip is actually going to be expedited just given that situation. But more than anything, analysts are looking at this trip as it being somewhat symbolic, a thawing of relations, if you could say, between these two nations. We saw President Ramaphosa of South Africa lead a peace mission of African leaders just about 2 years ago to Ukraine. But in that time, we saw many African nations somewhat feeling the pressure to have to pick a side within this conflict. And of course, you zero into times now. Greg was just talking to you about the pressure that Zelensky and Ukraine is facing from the U.S. South Africa, of course, in a very different context, is also facing pressure from the U.S. So perhaps this is an opportunity for these two sides to level set. What we heard from President Zelensky on X, he says he wants to use South Africa's role as G20 president to ensure active engagements by member countries towards diplomatic efforts. And if we just look at President Ramaphosa, he has at least tried to assert himself as a mediator to a certain extent. I mentioned that 2023 trip by African leaders. He is, of course, leading the role as the presidency of the G20 and has at least tried to put forward that he can speak to both sides. And so potentially he is able to negotiate something within these two leaders. We understand that President Ramaphosa actually spoke to Vladimir Putin earlier this week. And so, analysts aren't expecting there to be any dramatic or massive developments in terms of peace and negotiations, because, of course, there are those negotiations happening in Europe. But potentially, President Ramaphosa can use this opportunity to, again, assert his role that he is trying to put forward as a neutral stance, a mediator, and potentially look to other opportunities where these two sides can meet in the middle, especially after the past few years of a bit of a rocky relationship.
Jen, thanks for the update and another angle on it. Thank you very much indeed. Jennifer Sabuzaja joining us as we watch this trip by Zelensky being cut short to South Africa. Let us return now to what is happening with the reporting season that we now have underway here in Europe and get back into the corporate story. BNP Paribas shares a little lower this morning, actually quite a lot lower this morning. This after the French bank reported a dip in net income in the first quarter, despite the lender actually posting a record 40% surge in equities trading revenue. The bank's CFO, Lars Machenil, told us a little bit earlier on that it has limited exposure to President Trump's tariffs.
If you look at our exposure and you look at the sectors, and then you take the sectors that could be impacted by those tariffs, for us that represents quote-unquote, only 10% of our exposure. So from that point of view, I feel comfortable that Europe has compensating effects. And then for us, we are so diversified that we're not exposed in any material way to that kind of trading-related activities.
Let's get some analysis on what BNP Paribas delivered this morning. Claudia Cohen joins us now from Paris. The stock is down. The equities trading number is the big shiny story surrounding this set of numbers. But what is the market looking at below the surface that it doesn't like?
Yeah, the trading side is the shiny story. But this morning, analysts are actually calling BNP first quarter results a mixed set of results, mainly because the cost performance was a bit disappointed for analysts and also for investors this morning, because BNP cost rose by around 4% in the first quarter, which was more than consensus was expecting. And this cost rise contributed in a falling net income also compared to last year.
In terms of how it is dealing with the uncertainty that we're seeing at the moment, is this a case of the extra volatility that tariffs are generating, the uncertainty that's coming out of the White House is a good thing, but is there any other effect within the bank from the tariff story?
They are. I mean, the trading is really high. The equities trading were up 42%, which was more actually than some performance of the Wall Street banks. But obviously, there are downsides. We can talk about the M&A side. Obviously, the deals advisory are a bit down compared to last year because of all the uncertainty. So far, BNP is saying that they cannot see any liquidity problem with the companies they work with, so we cannot see any early signs of tariff consequences on credit risk, credit provision. And then obviously for BNP, and as other European banks, there is the perspective of lower rates, which could be bad things in investor minds today. So, yeah.
Claudia, great stuff. Thank you very much indeed. Bloomberg's Claudia Cohen joining us out of Paris on the BNP Paribas numbers. Let's stick with the banking story. Financial institutions around the world very much racing to figure out how to use AI tools, with the sector seen as one of the biggest beneficiaries of the technology. Speeding up processes, cutting costs, the kind of costs we've just been talking about. But there are also fears that it could potentially replace thousands of jobs as well. Core banking platform 10x Banking has unveiled a suite of new AI capabilities designed basically to accelerate this transformation and improve the efficiency that could come with it. I'm joined by the company's founder, a person we probably all know quite well, Anthony Jenkins.
Good morning.
Very nice to see you.
Thank you.
Explain.
So basically, if you want to deliver higher productivity, more revenue, lower cost in the banking environment, you've got to do two things. You've got to get access to data, and then you've got to apply these AI tools so you can make very quick, better decisions. And the tools we're rolling out today enable banks to do that across a number of different use cases, like when you're migrating off old technology, like when you build a new product, like when you want to interrogate your customer database to figure out which customers you're making money out of and which customers you're not. Those things you can do today, but it can take weeks and months to do them. We could do
so how much more efficient is it with an AI product?
Well, with the product we've built, for example, building a new product. Let's take a simple product like a current account that charges a fee, but only if you have so much money in it. If you have more, then you don't pay a fee. Yep. Now, to build that product can take literally months, sometimes years inside a bank today. We can do that in a few minutes using natural language. So a product manager can literally describe that in words, and then the tool writes the code for that product, so it can then be put into production after testing.
In terms of the banking industry is trying to go through this process, and big banks, JP Morgan, etc., are investing huge quantities of money in it. How much of a differentiator is this going to be, this kind of technology, in terms of performance that we are going to see quarter by quarter, year by year?
So this is going to be a massive differentiator, but it requires you to have two things. And this is not unique to the banking industry. Every industry has the same problem. Yes, these AI tools are incredibly powerful, but they're only powerful if you can get at the data, ideally in real time. Because if you've got a take it out of legacy systems and then massage it so that you can do something with it, that can take weeks. And then the data's old and out of date. So you need to have both things. But if you put those two things together, it can create not only a competitive advantage in terms of better products, but also things like better credit decisioning, better fraud decisioning. And that will deliver real power to banks on the top line, the cost line, and therefore on the bottom line. But is everybody
going to do it? Are all banks going to end up doing it?
Ultimately.
Are there some banks that are going to find it harder because maybe their legacy systems just make it more difficult? Yep. Are newer banks going to find it? I'm just kind of wondering, if an investor's watching this thinking, right, kind of how do I separate the pack? What are the key things I should be looking for?
Well, if I was an investor, the two questions I'd ask the bank are, firstly, what are you doing to modernise your core systems so you can get at that data in real time? That's the first question. Banks are doing that. Some are doing it more quickly than others. Some not doing it at all. That's going to be the key driver because the tools are available and the tools are in a way the easier component of this to work. So yes, you can have thousands of people working on AI tools, but if you're not modernising the underlying data, you're not going to be able to deploy them. So analysts and investors should be asking both those questions of bank CEOs and bank CIOs and making sure they get credible answers.
It would be remiss of me to not have you sat there and just get your take on the world right now. What are you've run a big bank, you know exactly kind of how the world works, you know how the various components fit together. How would you characterise the tumult we're going through at the moment? Talk to me about the uncertainty that you see. Do you see any light at the end of the tunnel?
I mean, that's exactly the issue. Business people are very adaptable, right? As long as they know what they're doing and what they're shooting for, they can deal with almost anything. And in this country, we've seen it with Brexit, with COVID, the Ukraine war, all of those things. But what's so difficult about this is it's so unpredictable. And as we were just seeing in the previous report, actually volatility is good for banks trading businesses. But what's not certain is the longer-term impact on the credit books. Because if we do see a downturn in the global economy, if we see a recession and possibly with inflation as well, that could start to put real pressure on the credit books of banks around the world.
And what do you see? What is the F.C. Jameson base case at the moment?
At the moment, it's the breadth of outcomes is so broad. I mean, we just don't know. And anybody who tells you they do is frankly lying to you. The level of concern is very high. I've been around the world. I was in Australia, New Zealand a month ago. I was in New York a couple of weeks ago. Everybody is extremely worried about this because the business community, whether it's a bank or a large multinational, want things to settle so they can adapt to it. But it's this constant uncertainty that's really causing the challenge.
Great to see you. Good luck with the products. Thank you very much indeed for stopping by to see us. Anthony Jenkins, the founder and CEO of 10X Banking. I just want to come back to some of that uncertainty and how different parts of the world react to it. Ollie Rehn is just making some comments. We've obviously got the IBM meeting taking place currently in the US. The ECB should not rule out larger interest rate cuts, according to Ollie Rehn. Few good arguments to pause rate cuts at the moment, whilst we retain full control, full freedom of action and be agile. But he's talking about the possibility of larger interest rate cuts. The expectation is that the ECB certainly cuts down to around neutral. Let's call that circa 2%, potentially goes below that into accommodative territory. I've even heard some people talking about it going down to sort of circa 1%. Probably wouldn't want to go any further than that towards the neutral bound. But he's not ruling out the possibility of larger interest rate cuts. Really interesting debates, I suspect, happening on the Governing Council at the moment. Coming up next, we're going to go back to the tariff story and fold in the drug makers. Roche and Sanofi out with numbers this morning, both with positive results. But we've got this big tariff story hanging over the pharma sector. We'll dig into all the details next. Emily Field is going to be joining us from Barclays. This is Bloomberg. Let's talk about some of the corporate news. Kering, Gucci, under a little bit of pressure this morning. We see the stock coming down and down and down. This basically is around Gucci. Gucci accounts for around 60% of Kering sales. We've got a new guy coming in who's going to shake things up, but we've got to wait for a while. is it basically too early to talk about a turnaround? Well, Charlie Wells is here to talk about some of the consumer stocks. Let's start with Kering.
Let's start with Kering, and let's start with the difficulty that Gucci is clearly having. So important to that Kering brand, but difficulty having kind of that transformation from more of a fashion brand to a luxury brand. And what Kering really wants is for Gucci to kind of transform into luxury, where they can withstand more uncertainty, where they can kind of not be so subject to kind of fashion trends that may change and come and go. And we've seen that with Gucci, right? You know, about a decade ago, they had some really big hits. They've struggled to find that. I think this is why they're bringing in this new designer. No pressure, though, because that share price is not performing well. These earnings that they reported, not great either.
So when do we start to see the effect of that?
You know, it's going to take a while, right? Because his designs are really not coming online until September. It takes usually about 6 months for that to start happening. And then the question is, are those designs, when they come online, are they going to be a hit or not?
Adidas has certainly got a hit on its hands.
They've got a hit, and it's just kind of time and time again. This is sort of the greatest hits catalog, and it's basically these retro sneakers. So the company reported yesterday better than expected earnings, and it really is on the back of the likes of the Samba, the Taekwondo, and the Tokyo. And it's really striking when you kind of compare Adidas to Nike, because Nike has really been struggling recently. Adidas on the kind of back of a 2-year kind of hot streak, and it really is these sneakers that are helping kind of boost the firm.
Talking of kind of legacy, Nokia, it's a completely different business than it used to be, so I can't really make that reference. What are the numbers telling us this morning?
You know, not great. So their operating profit for the first quarter missed expectations. It was down 74%. We know that 5G, rollout has been really difficult for telecoms, but what everyone really cared about was that forward guidance. And what management said was they are going to have a difficult time meeting the top end of this year's guidance. They also talked about tariffs. They said that in the second quarter, operating profit's going to probably take a 20 to 30 million euro hit. So, not massive, not nothing, but speaks to some of the supply chain issues that they could be having going forward.
Charlie, great stuff. Thank you very much indeed. Some of the consumer stocks on deck this morning. Let's turn to the pharma sector. Sanofi posting strong earnings that beat estimates this morning as sales for its skin and asthma drug Dupixent continue to do well. Meanwhile, in Switzerland, Roche, which recently announced an expansion of production facilities in the US, posted revenue pretty much in line with expectation. Emily Field, head of European Pharmaceuticals Equity Research at Barclays, joining me around the table. Good morning.
Hi.
Nice to see you. Hi.
Nice to see you.
What did I learn this morning? What did I learn this morning?
Well, I think fundamentally it looks like everything's on track for, two of the bellwethers reporting in European pharma. Good numbers, revenue for Roche and Sanofi, and then a nice bottom line beat. But we have these big overhangs that we...
So many.
Of course, the Commerce Department investigation going on into tariffs, so none of these companies can include anything in guidance because we don't know what they're going to be. And then more specifically to pharma biotech, just, are we going to see any ramifications from some of the DOGE cuts at HHS and FDA?
Okay, so let's dig into that in a little bit more detail. The guidance, these companies presumably aren't in a position to change guidance at this point. You wouldn't want to change guidance. So how useful is guidance?
Yeah, so sometimes we do see these big pharma bellwethers raise at Q1. It's more of an... not the rule that they do that, but I think we're expecting them all to maintain, just given the current political environment. There's no need to kind of draw attention to yourselves as doing very well when we also have, of course, drug pricing in the U.S. Headlines yet again.
Yep. And we also got drug headlines in Europe as well. We saw a letter in the FT yesterday from two of the senior leaders within the industry talking about raising drug prices here too. Do I put this all in the same bucket in terms of what is happening? Is this an offset story? I'm wondering how the pharma sector is seeing this.
Yeah, I mean, it would be really interesting to hear what the companies had to say on these conference calls. Of course, they talk about pricing for innovation, but just sort of all of these overhangs, pricing in particular, which we thought was somewhat nullified with the Inflation Reduction Act, now is back as a huge overhang. So the sector in what's becoming a more challenging macroeconomic environment is not behaving defensively.
Okay, let's go to the number of people that are there to help these companies deliver the drugs that they want to in the future and all the checks and everything else at HSS. Are we going to have problems in terms of the timeline? Because bringing drugs to market is kind of what needs to happen. Pipelines need to carry on and they need to be filled. And if there's any delays in that, that's huge.
Yeah, that is. We're really focused on upcoming approval dates in the U.S. for all of our companies. Now, when we've asked the companies individually, the messaging from all the management teams is everything's on track, not seeing any delays. However, that's a big contrast to what we're seeing in some more of the, pharma-specific press that's talking about, disarray at some of these agencies. So when will this impact the big guys, if at all, remains an open question.
All of that. So you've been through a lot. There's a lot going on. We've got results to deal with. We've got what's happening in terms of the tariff story, the pricing story, what is happening in terms of the regulatory story. In theory, against an economic backdrop that is difficult, these are the companies that you would want to go and invest in. Yet, at the moment, that is not appearing to be clear. Why not?
Yeah, I think it's just because, this is one of the sectors where they have to do a sector-specific tariff investigation. So we've seen, like, Johnson & Johnson was able to include a tariff impact for their medtech business, but not for pharma because we don't know. So I think until there's more clarity on that, people are holding back firepower, which we think that hopefully if there is some clarity on the tariff front in particular, that then you might see a broader rally in the space because, these stocks perform very well during the GFC on a relative basis. You're still going to go to the doctor even if it's in a recession. So
in a recession, if we get some clarity in a recession, they start to perform as they normally would.
Hopefully, yes. Well, not hopefully recession, but hopefully the stocks do a little better.
Absolutely. In terms of we're starting to get into the earnings season. What else are you looking for? There's an FX story that's beginning to emerge as well.
Yeah, and that was a super interesting component of Roche's report this morning. They said using end of March rates, sort of a flat impact on FX to sales. If they use April 23rd rates, it would be a 5% headwind. Yeah. And Sanofi lowered went from a tailwind to a headwind.
So Novartis report in dollars, Astra report in dollars as well. So how does that affect them?
Yeah, so they should be a little bit more insulated from these moves in the dollar. But for the rest of them, the euro-denominated reporters like Sanofi, Novo, and Danish kroner, FX could creep up to be more of an issue.
So what else are you looking for the rest of the reporting season?
Yeah, I think certainly there's a lot of focus on Novo Nordisk. Has not been a great stock for a number of months now, and what we're waiting to see is Wegovy prescriptions in the U.S. have been pretty flat. We know that this phenomenon of compounding or being able to buy a bootleg version is expected to go away in May. So how do they incorporate this all into guidance? I think is going to be...
How big a threat is the Lilly oral?
Yeah, that data that we got last week, it was on the higher end of what I would say were investors' base case expectations. Now, when we speak to doctors, they still think injectables are where you're going to get better compliance and better results. But there's a lot of needle-phobic people out there, so the orforglipron could be a very, very big drug.
Great to catch up with you, Emily. Thanks for stopping by. There's so much going on. Fascinating conversation. I could carry on for hours. Emily Field, Head of European Pharmaceutical Equity Research, joining us from Barclays. That pretty much wraps things up. Danny will be up shortly. But just let me tell you, don't miss Bloomberg Chief Future Officer tonight, which features BBVA's Chief Financial Officer. Speaking to Kriti Gupta, that's coming up. 6:30 p.m. is the airtime for that product. As I say, Danny is up next. The brief is coming. This is Bloomberg.